Hi, folks. Dan Bird here on Thursday, July 11th. I'm doing a midweek update since we got the CPI number today, and some very interesting things happened today. So let's jump into it real quick, and let me show you what's going on. First off, we'll take a look at actually, you know what? I'm gonna jump over and show you my website, just in case anyone wants to join or get the newsletter. Breakpointtrading.net, that's where you can find me. The newsletter, it's free each week. Just click on this box right here in the upper right, and you can download the newsletter. Or if you want to be reminded that it's available, down at the bottom of the homepage, $0, doesn't ask for a credit card or anything, or for all the other content, a lot of that I'm going to show tonight. You can just sign up right here. It's $99 for a year, but there's a lot of stuff. I think of it like a toolbox, basically. So first thing I want to show is all of these sectors. So CPI today came in much tamer than expected. The last month was 3.4. The expectation was 3.1. It came in at 3.0. And I had talked with Zuber, and I said that by September, we're going to be below 3. And it looks to me like that might happen next month. And I'll show you why in a minute. But here's what happened today. So this is the 10-minute chart. One at the top is the S&P. You can see how yesterday it had a big rally leading into today's number. This is what I call a buy the rumor, sell the news kind of day. So everyone was hoping for a lower number. Everyone was buying, and then we got a lower number, and everybody was selling. That happens. That's the way the markets work sometimes. So you just have to be prepared for that. Down below are the sectors. And what I've talked about quite a bit in the past is that mostly what's been driving the market higher is the technology sector in particular, and primarily the big cap technology stocks. We're going to take a look at what happened today because it's very interesting. But first, down here, you can see technology. Even as the market was selling off, it was primarily technology that was selling off in addition, or kind of leading it, if you will. So discretionary technology and communication services are the three main aggressive sectors. All three of those sold off today. And you can see this red line just like up here, that's Monday's open. So they're all right now below Monday's open. The financials actually rallied. So ended up higher than Monday. The industrials rallied, and I'll show you something there that's really interesting. But industrials in particular has not been doing well, but rallied great today with the prospect of lower interest rates and the Fed rate cut. Materials on the right-hand side, these are all defensive sectors. Healthcare rallied. Staples, while it's still below Monday's open, it rallied today. Energy rallied a little bit, still below Monday. Utilities had a big day. And materials also above Monday's open and had a big rally today too. So what's this telling us? Well, it's telling us that the aggressive sectors are selling off and the money is rotating into the defensive sectors. As I had mentioned before, the period from June 26th to July 12th, which is tomorrow, is the best 2 weeks of the year. And we've had a fantastic rally. In fact, I'll go back on the website, and right down here, we'll look at the S&P. You can see this rally that the S&P had, and you can see right here, end of June is right in this period, and this is the last couple of weeks, last week and a half. Big, huge rally the last week and a half, but look what happened today. That is an engulfing candle, which means it opened higher than yesterday's close, and it closed lower than yesterday's open. So it engulfed all of yesterday's move, basically gave back the whole thing. Now, the next question is, what will happen next? So there's a support level right here at about 5,500, a little above that. That I think, and that's right about where the 21-day moving average is. It's at 54.82. So I suspect that's probably where we're headed to. Tomorrow might be a recovery day, we'll see, but it might be a continuation day as well. But after that, starting next week, we're into one of the hardest, worst periods of the year. So this sell-off may continue. If we look at the NASDAQ, so the S&P and the NASDAQ have both pretty much been the large cap stocks. So the NASDAQ was sold off even harder than the S&P, basically giving back the last 3 days of gains on the NASDAQ. So you can see on the momentum indicators are all rolling over and starting to move lower. So I suspect that this one is going to head back down to the reversion to the mean, which is the 21-day at 18,000. And then we'll see if it will continue after that. But we're going into the worst period of the year. And we've got the conventions coming up as well, which is going to cause a lot of, probably a lot of consternation in the markets. But look what happened with the Dow. The Dow had been the laggard while the S&P and the NASDAQ continued higher. But the Dow today actually did not sell off like the other two did. The Dow actually gained some on the day. So the Dow was right at the top of this channel, the sideways channel. So it may actually break out and continue higher. So the Dow was the one that was kind of bucking the trend of the sell-off in the S&P. One way to look at that on the charts page, we can look at what I've showed before, which is the cap weighted versus equal weighted. And this will make it really clear. The cap weighted, the S&P cap weighted top 10, it's actually 9 stocks because Google has 2 symbols. So both of those symbols ended up in the top 10. But of these 9 companies, 35% make up the SPY, the S&P. For the NASDAQ, we'll make this a little bit bigger. For the NASDAQ, these 9 companies make up 50% of the NASDAQ. So you saw what happened. The NASDAQ went down much more than the others. And I've been saying that for a while, that if those big cap names start to roll over, then the whole market is probably going to roll over. But it looked like there was rotation out of aggressive and into defensive sectors. So the money might not necessarily leave the market, which basically the way I interpret that is we'll still get a sell-off, the market will still go down, but we won't get a big crash. And it's kind of reflected here in the equal weighted. So you can see even as the cap weighted went down a little bit, the equal weighted actually started to recover. And the same thing down here with the NASDAQ. So the equal weighted actually is rising above the previous highs, even though the cap weighted went down slightly. So it's very interesting what's going on. The other thing that's interesting and something that I do every day, I update this page, and I update the sector charts, and you can see it's a short-term, medium-term, and long-term. I'll show you this a little bit in another way on the website. But the XLU, which is utilities, that is the most defensive sector, had a short-term up signal today. So it's just starting to move higher. And industrials, which I talked about before, had a short-term up signal, bullish signal today. So it changed from red or bear to green, bull. And if you look right to the right-hand side over here, these are all of the industrial industry groups. And look how many of those had up symbols today. So they are all green. So a lot of these in the industrial side, if I click on industrials up here, you can see right here, industrials had a great day. It was kind of trending down, but it's really turned around, starting to go back up now. So industrials had a great day. Financials had a pretty good day. If we look at financials, they're almost ready to break out to new highs over here. And real estate, of course, had a great day today as well. The real estate, of course, if rates are going lower, then real estate should do well. But healthcare did pretty well. Consumer discretionary, interestingly, actually did pretty well, even though it sold off pretty hard today. So automobiles in particular, that's where Tesla resides. You can see automobiles as a shooting star, which is a trend reversal. So that's a bearish candle. So we'll see if that continues down. So we'll look at the look at the Magnificent Seven here in a second as well. Let's look over, before I jump over there, one thing I wanted to point out is on the unemployment rate. I made a change to this chart. The SOM rule, I had been saying that the SOM rule was when the 3-month moving average of the unemployment rate rises by 0.5 point above the 12-month moving average, but that's not exactly what the rule is. I went back and researched it, and the rule actually is when the 3-month moving average, when it's 0.5% above the previous 12-month low. So what that means is I have to go back and look at what those 12-month lows were, or the 3-month average. It's a 3-month average over a 12-month period. So whatever that low was. So in July, this is 3.6. So the SOM rule says 0.5 above 3.6, which is 4.1. And guess what? 4.1 is exactly what we got. So we are right at the SOM rule right now. Now in August, it will be 3.65. So this will move up to 4.15 for the SOM rule. So if we come in at 4.1 next month, then we'll be a little below it. If we come in at 4.2, we will be a little bit above it. And in September, which is what I'm saying the Fed probably is going to have their first rate cut. In September, the SOM rule is at 3.7. So you add 0.5 to that and you're at 4.2. So any way that you cut it, it looks like September we're going to be at 4.2 and we will be at the SOM rule probably for 3 months running. So that's the other reason why I think the Fed probably will cut rates. We'll see what happens. One of the other things that I added, and these all update in real time, by the way, so every day they'll update automatically. I added the unemployment rate, but I added also jobless claims and sentiment just to look at a comparison with those. So we have the S&P up above. Here's the unemployment rate right here. So up to 4.1, and this shows you the what the actual rate is, so 4.1. And this red line is a 21-day moving average. So it is now, it's been below its moving average. It is now above its moving average. That means it's starting to accelerate. The blue one right below it is initial jobless claims. And what you'll notice on that is that it also, its moving average is beginning to turn up and starting to trend higher. So not only is the unemployment rate moving up, but the jobless claims are also moving up, even though they went down last week. And then finally, the University of Michigan consumer sentiment is now below its moving average as well, which it was back here in September, October. This was, remember this, the July to October period last year was the cyclical bear market. That was the sell-off that we had. I would not be surprised at all if we get that again this year, July to October. We get a sell-off very similar, and that might actually have started. So we'll see if this continues tomorrow and into next week. But that July to October sell-off period, cyclical bear market, it's a short, very short bear market, that may happen again. So we'll have to keep an eye on it, see what happens. So the last thing that I want to show here is the trend models. And this basically is essentially what I use for my market bias matrix, which is also really interesting. So the market bias matrix is something that I update every day. I just finished doing this for today, and everything that you see in bright squares, that means it just changed from bear to bull if it's green. And if it's red, which there are no red ones today, if it's red, that it means it just changed from bull to bear. And it's in short term, it's the left column, medium term is the middle column, and long term is the right-hand column. So you can see the ones that have just changed, and the key thing is to look at the chart on the right, which basically essentially just charts all of this that's on the left. And you can see this sideways channel that all of this has been moving in for quite a while, 2 months or more than 2 months. We've been going sideways, except for today. Today it broke out. Down here you can see that the orange one, which is the short term is the one that's really accelerating. So you can see all the green boxes over here in the left-hand column. There are a couple in banking that just changed in the medium term as well. So banking is starting to pick up. That one's just starting to trend higher as well. So all of these are starting to go up, and this one up here is starting to go up. But a lot of that, I think, is the rotation. It's the rotation out of the single sector of technology and moving into a lot of the other sectors, which actually is healthy if that continues. It's unhealthy if everything crashes and it doesn't move and this actually starts to go down instead of up. But it's going up. It's actually broken out of that sideways trend. On that same topic, if I look at VectorVest and look at the graphs, so this is the market timing graph, and look right here. This is almost identical to my chart that's on my website. And you can see with VectorVest, it has also been just moving directly sideways for 2 months. It broke out yesterday, and it actually confirmed today. So it broke out even more. And you can see everything is starting to move up. So again, VectorVest is 9,000 stocks. It is a very broad index versus something like the S&P and the NASDAQ, which are cap weighted and have really been driven by just a few names, large cap names. Whereas this is 9,000 stocks that are driving this, which is the reason it's gone sideways. But now it's broken out. So we'll see if that will continue. It's very positive in general, not good for technology, but good for the overall market. So having said that, let's go up and look at the trend models, which is very basically the way that I do this short-term, medium-term, and long-term over here, but on specific indexes, sectors, and stocks, the Magnificent Seven. So the way this works is the short term is essentially the 5-day moving average crossing the 21-day. The medium term is the 21-day crossing the 50-day, so it's a faster signal. And the long term is a 50-day crossing the 200-day, a slower signal. Sorry, I'm drinking some water because my voice is getting dry. So what you see is the actual dates when those crosses occurred. So the S&P right here, it's bullish across the board, and the short-term cross on May 6th, medium term on May 14th, and the long term all the way back on January of 2023. If it's highlighted in yellow, that means it just changed this week. So you can see gold just got an up signal, medium term. Bonds just got a short-term up signal, and the Russell 2000 in particular, that one's really interesting too. We'll look at that. Got an up signal also yesterday. So let's go through each of these. Well, first, let's look at the sectors, and then we'll look at each one of these individually. So in the sectors, staples this week got an up signal, utilities, healthcare, these are the 3 defensive sectors. Energy got a down signal. Materials, that wasn't this week. So anything that's highlighted, XLI, industrials, like I mentioned, just got an up signal this week. And then finally, the Magnificent Seven. All of these have not really switched other than Super Micro, got an up signal this week. None of these have switched yet, but when I look at the actual charts, they're still a little bit away, except for a couple of them, Netflix in particular, but they're getting very close to giving short-term down signals as well. So let's take a look at each one of these. And as I go through, what I want you to focus on are the arrows. So they're color-coded just like the trend model. By the way, these will update in real time every day as well, even as the market's open. So you can see if you wanted to play the S&P, if you wanted to do futures, for instance, then you could buy one contract on a pink up signal, buy a second contract on the medium signal, and then just wait for it to change. So right now, there's the engulfing, bearish engulfing pattern. That's a reversal pattern, but it's just sitting right on that short-term line. So it hasn't given a signal yet until the short-term, the pink one crosses the blue one like it did here. So that's what to focus on when you're looking at these. Here's the NASDAQ, huge sell-off on the NASDAQ. We'll see if that continues. I think it's going to go down at least down to the 21-day moving average. And if these cross when it gets there, then that will give a short-term down signal. And you'll see it on the trend model. Here's the Dow Jones with a indecision candle. So that's sometimes a reversal candle. We'll see what happens. Here's the Russell 2000 actually broke out. So it's up at, it closed at new highs up here. So the Russell 2000 actually has a short-term up signal as well. I just haven't put it in yet, but I'll do it right now. So this now has a short-term up signal as of right here. So there's the NASDAQ. Here's the Magnificent Seven, huge down day. So this highlights what I've been saying, that all of those big cap technology names that have been driving the market higher, this gave back, this is an ETF for the Magnificent Seven. This gave back 1, 2, 3, 4, 4.5 days worth of gains. Almost pretty much a week worth of gains. It gave it all back today. So that really, and look at the volume down here. That really shows what this is doing. Bitcoin just had been lackluster, just going down, and it really hasn't shown any signs of coming back up. Gold just gave a medium-term up signal, so it's breaking out. Here's bonds. Bonds gave a short-term up 3 days ago. So if you wanted to play bonds, you could have got into the TLT and ETF for bonds 3 days ago before it took off today. Here's a 10-year Treasury. 10-year Treasury had a huge down day today. So dropping like a rock, it's just about ready to drop down through this support level. And if it does that, I mean, it's going to probably be below 4% pretty soon. Here's the VIX. So I've been watching this today, and the VIX actually was up for most of the day, and it actually pulled back right at the very end of the day. So the VIX, if this continues higher, and you can see it just also gave a short-term up signal today, right here, today's candle actually. So it is now a short-term up for the VIX as well. So now we're into the sectors. Here's technology, gave back 4 days worth of gains. Here's communication services. The first three are the most aggressive sectors. Communication services, where the internet stocks are, like Google and Netflix. I'll show you Netflix in a minute. Here's consumer discretionary, where Tesla resides, and Amazon. Here's the consumer staples. You can see that they still have not given short-term down signals yet. However, if they continue to trend lower, they will. And that's the way to use these to make money. You know, make your move. You can buy these ETFs if you want to, but do it when the short-term signal changes. Here's the utilities, which just gave a short-term up signal today. I'll put that one in here. Right here. So just got an up signal today. Here's healthcare, actually got the up signal yesterday. Here's energy, still down, but trying to recover. Here's materials. Material has not quite moved over. So if this goes up tomorrow, this is where gold resides. So if this goes up tomorrow, then this will also get a short-term up signal on the trend model. Here's industrials. Industrials is another one that just gave an up signal today. So that is now in an up signal. These are reflected on the trend models. I just haven't put the arrows in on the chart. Here's financials. It got an up signal way back here. So financials has been doing really well. Real estate did great today. Look at that big, huge gap up in real estate up near the top. Now we go into the Magnificent Seven. There's Google. Google just gave back 1, 2, 3, 4 days worth, almost 5 days worth of gains on big volume. Amazon gave back quite a bit. Here's Apple. Didn't give back. Apple hung in there pretty well. It did sell off, but didn't go down too much. Meta, huge down day on Meta. Now, notice how far away the pink line is from the blue. So it's going to still take quite a bit more selling for the short-term signal to trigger on most of these. Here's Microsoft, same kind of thing. It's starting to go down, but it really hasn't given a signal yet. Here's NVIDIA. NVIDIA had a big down day today as well. For those that are holding NVIDIA, one thing that I bought just for hedging is NVDS, and this is an NVIDIA short, which actually moved higher today a little bit. This is a 1.25, so if NVIDIA goes down 1%, this goes up 1.25%. That's how it works. So there's NVIDIA, and it closed right near the low today as well. Here's Tesla, huge down day on Tesla. So for those that were in my Zoom call that I did for subscribers last weekend, we talked about Tesla, and I said with Tesla, I'll actually show you a 2-year chart for Tesla. And what I said on Tesla was right here at about 260, right here, which is right about 265. So this was last Sunday. So today's Thursday. So Tesla would have been down here. Actually, wouldn't even have had that gap yet. So Tesla would have been down right about down here. So on Sunday on the Zoom call that I do for subscribers every month, it's an open forum and anyone can ask anything. I said Tesla is going to probably go to this point where all of these people that bought Tesla way back here in December of 23, and then Tesla just sold off from that point on, they want to just wait till it gets back there to break even. And that is at 264. And I said, when it gets to 264, all these people are going to start selling. Regardless of what happened with the rest of the market today, I think this probably would have happened anyway. But now what we're looking for is to see if Tesla makes, so you can see this little cup down here. In fact, I can draw it in. This is a Investors Business Daily thing. So there's a cup right there. Make this blue. So there's the cup. So next thing we want to look for is a handle. Whenever stocks do something like this, go down and make a cup, the next thing to watch for is whether they will make a handle. The handle will be over here. And the handle should not come down much more than about 10% at the most. So you don't want the handle to come way down here to $200. You want to see a handle come down a little bit where all of these people are getting out just to break even, but there's still lots of buyers still waiting there. So this is the thing to watch. And you don't wait until you say, okay, at 225, that looks like where the bottom of the handle might be. I'm going to buy at 225. No, that's not the way to do it, because it could go down to 200 or 150 or 100. You want to wait and see if it starts to curve back up. Now, technically, the way that Investors Business Daily recommends doing it is you wait for it to get back up to the resistance line right there. So when it forms this little cup over here, you wait till it gets back up to the resistance, and as soon as it breaks through, that's the buy point after it breaks through. So lots of people that follow Investors Business Daily have recognized this cup and handle potential, and they most likely, especially some of the bigger traders, most likely have put buy orders right above, right around 275. So once it hits there and breaks out, then people will be buying. There'll be buy orders there. People that have shorted Tesla and might still be short, although I don't know why they would, but if they are still short, then they will definitely be getting out when it breaks out of that resistance level. It still has some other areas to get through. It's got one there, and then it's got the high right there. But the way to measure this is you take the distance between here and here. That's about 48%, but it's essentially 120 points. And that's the target on the upside. So about 120 points on the upside as well. So what that means is if Tesla does break out of that cup and handle, and there's no guarantee that it will, but if it does, you can add 120 to roughly, let's call it 260, and you've got 380, which is right at the top of all of that. That's right back to the old-time highs. So potentially that's where it could go. But you have to wait and see if this handle forms over here. All right. Anyway, that's Tesla. Netflix. Look at Netflix. Netflix is just about to give a short-term down signal right here. I actually did a debit spread, a put debit spread negative, meaning I think it's going lower on Netflix early today. I was looking at it yesterday when we had this one, but it still wasn't close enough to giving that short-term down signal. Today, tomorrow, it will give a short-term down, even if unless it bounces way back up above all of this, even if it stays right down where it is, it's going to get a short-term down signal tomorrow. So that's why I did a bear put on that. We'll see what happens. Here's AMD. AMD actually hung in there pretty well. It's been showing a lot of strength here lately, in fact. SMCI, it's got a short-term up. SMCI hung in pretty well. Oracle actually went higher. Oracle now sold off 3 days ago. But today it actually hung in really well. So Oracle probably of all of these is the strongest. And I've added Palantir to the mix as well. Palantir had almost an engulfing candle. So this is one that might come down a little bit as well. So if you've been looking to try to get into some of these, wait and see if that sell-off occurs. Maybe we'll get back to the 21-day. We have to see how long it's going to last for. If it's similar to last year, it's going to go all the way till October, right through the conventions. So, and if that happens, if it does continue lower, we'll look at the S&P again. If this does continue lower, then we are likely to get back here to 530 where the 50-day is, and maybe all the way back here to this high, which is about 520, 525, probably 525 in this area. Very likely to get back there or even lower. So it's going to be up and down. It's going to be a choppy few months, but you have to be careful between now and then. So that's what happened today. CPI came in great. I think a lot of traders were kind of expecting it. It actually did better than I expected, frankly. But the market sold off. So you have to go by the reaction of the market, not what you think, what you anticipate is going to happen. And we don't know tomorrow. Maybe the market tomorrow will say, oh, you know what? It really was pretty good, and start pouring back into all of those technology names. We don't know. We'll find out tomorrow. But next week starts one of the worst periods of the year, and we'll have to see if that comes to fruition again. On the charts page, and I talked about the Santa rally way back when it was going on in December last year, but here's the Santa rally in December, January, the end of January. I said, you know, we had two of the three were negative. The other one was positive. And normally when that happens, the market ends higher for the year. And on top of that, we're in an election year, which normally the market ends higher as well. So you can see the close in the beginning of this year was 47.42. The close today was 55.84. You can see how far it's gone. Now it really needs to pull back because it's really probably extended too much. So it really does need to come back in. Even all the way down here to 52.50 would be a very positive thing. It would be healthy for it to pull back to this support level back here. But there's no telling what will happen. But that's where we are right now. Good luck trading. Be careful out there. It was a really interesting day, just watching, you know, where things were rotating into, things that had been lagging previously, like industrials, now starting to take off again. By the way, actually, if you look at the website on the portfolios page, on the left-hand side over here, I have dividend candidates. These are candidates that I identify at the beginning of the year, and just identify 10 of them and just let it run. And then at the end of every month, I will update this, and you can see where it is right now. But I'm going to show you as of today what those look like. And remember, I said that financials had a good run, and most of the ones, especially the ones in my own scan that I run. So this is the Dividend Aristocrats, which is an industry standard. This is the VectorVest scan for dividends. It's actually the lagging the most. And then the one that I run, my own scan, which has some very stringent rules to identify candidates, is doing pretty well. But if you look at where they are today in VectorVest, here's all the scans in the portfolio. So mine is at 8.41. The VectorVest one is at just about 2, and Dividend Aristocrats is at 9. So we're about halfway through the year. So annualized, that's about 17% or 18% for Dividend Aristocrats. So that's a way to play it at the beginning of each year. I will run that scan again. Last year, they did really well. This year, they're still doing pretty well. Might end up the year, and especially if there's a rate cut, then I think banks are going to take off even more than they are right now. All right, that's it for today. Hope everyone has a great day, and we will talk with Zuber on Sunday. Thanks, everyone.